of Madhya Pradesh, India. He has led and participated in over 60 advisory assignments supporting central and state government reform initiatives in the Americas, Africa, Asia, and the Middle East. He holds a master's degree in public policy from Georgetown University and has attended specialized training programs in public administration in France and public finance at Harvard University. Here at MIT, he focuses on regional economic development, expenditure program evaluation, and organizational change. So he is ready to present to us some of what he presented over IAP and get your general feedback.
Yes. Hello. Thank you for being here. We have about 54 minutes, so I would like to leave as much time as possible for questions. So perhaps we can start with the presentation. We're going to try to look at energy access policy, rationale for government intervention, and some public finance questions. My background is basically on government finance or Ministry of Finance. Perhaps there's an overlap in the work that you do as a group. In terms of energy access policy, my sense is that there are typically programs in the budget that deals with this issue, and there are a number of ways where government intervenes. So this is where I think that there's an overlap between government finance and a topic such as energy access policy. So very well. So in terms of our terms of reference, what are we going to be doing tonight? Basically, the idea is to provide a framework for evaluating investment projects from alternative points of view, so that we have a sponsor, we have society, we have stakeholders such as the less well-off, sometimes the revenue authority, because when a project starts, the government collects revenues. And also we will look at the technical lens, so we can look at projects from a financial point of view, cash flow analysis, if you will, economic point of view, benefit cost analysis, distributive, which is if we use the same unit of analysis for financial and economic, could be the differences between the flows, fiscal and risk. So let's start. Typically, as part of the budget, we're giving some information on what are some of the goals that we're trying to achieve. For the purposes of this presentation, I'm basically saying that energy access policy is defined in this presentation as one to address impediments to energy services access. So it's just a general sort of, this is typically the statements that we find in budget documents, in policy initiatives, but again, we need to frame sort of the discussion. So basically, we're trying to deal with expanding energy access in a way through a number of initiatives, including investment projects. So in terms of a rationale for government intervention, we may use the market failure argument, basically public goods under provision, therefore there's a rationale for state action, government action, and this is sort of how we frame government intervention through the budget, through the spending process specifically. Having said that, of course, there's always a space for the private sector at times. So again, at this point, this section, we're trying to match public finance questions with government intervention arguments where possible. The government intervention argument, the government rational argument is market failure, public goods under provision. So the question that we're putting forward is how do we ensure energy projects make a positive contribution to society and benefit the less well-off? So in this case, we're thinking in terms of access to energy. So again, we have public goods under provision addressed by a public sector project. That's one alternative that we use through the budget. The second one is by a PPP. So the private sector comes in and the government takes a different role. It's involved, but takes a different role. So these are two ways where we find that we can address this issue of energy access. Okay, so at this point, perhaps what I would like to do is I would like to distribute some handouts because we may not have a lot, so we may need to share this. The idea is basically to look at some numbers and come up with just some basic understanding on relationships and and basically to try to understand just the big issues or the big questions. What we see basically is you have in the public sector provision. Typically, what you have is typically the sponsor, which could be a ministry, for example, of energy, working through a subcontractor and providing services. So you've been given a sheet that includes a financial point of view from the point of view of the sponsor. This is the government. The executing agency could be a ministry or otherwise. And you have a cash flow analysis. So this is a financial point of view, government project, and we find that we have both cash inflows and outflows. We have cash inflows of 30, cash outflows of 130, so we have a net cash inflow position of minus 100. We're assuming all these values are in net present values. So again, from this point of view, we find that the government project gives us a net position of minus 100. So this is a cash flow part in government provision. This is the economic part, the second one, that deals basically with the benefit cost analysis. So what we're trying to identify is how much society gains as a result of implementing the project. So we have identified basically as gross benefits 300. We have identified as gross cost. So basically gross benefits, economic cost, you can think of 80 and 20. And the net benefit, we have, these are dummy numbers, but we have estimated them for the purposes of this exercise as 200. So basically 300 minus 100 equals 200. Very well. Just notice that the values here, 80 and 20, are lower than 130 here. Typically in the economic analysis, we do not take into account taxes because they are transfers. There are no use of resources. So you will find often in the benefit cost analysis, if you compare both, that you have paid more on this side because there are taxes involved, right? So that's part of the reason why the economic benefit is what it is. Now, if you do this analysis with the same units, meaning, let's say, a local currency in real terms, you can also come up with estimates of the distributive impact of the project. For example, you may have in this case that, for example, the clients or the customers are this is the total benefits of the project. It's just sort of a measure of willingness to pay. This is, in a way, willingness to pay of a group of consumers. This is what they actually pay as a group, and therefore they derive the difference. So 300 minus 30 equals 270. So that is what, in this case, the consumers as a group appropriate. Okay, I just mentioned this because in the next example that you will see, this will change when we have the private sector provision. So in this case, of course, the group of consumers, the clients, are benefiting. The other difference of our stakeholders, there are much more points of view here, many more stakeholders, but we have limited them to the clients and the government. The other sort of stakeholder is the government, basically because there's a difference between financial prices and economic prices because there are taxes. So we capture that here, the differences, and we assign them to government. So that the government, by implementing this project, of course, is incurring a loss here, but the operation is also bringing some revenue here. So this is revenue as a result of taxes. So again, financial point of view, economic point of view, distributive point of view. So we basically see that in this case, the total sum of, let's say, the differences, we have estimated them at 300. So that's the 270 plus 30 from the government. So this is sort of a first take, if you will, on sort of the approach. I just want to bring this to your attention because what often happens is that you have, of course, we all have our professional biases. Typically, these exercises are conducted by economists, financiers, engineers, and also by the public sector and the private sector. So typically, sometimes the points of view are not reconciled. Okay, I just want to sort of show you that they can be given certain precautions. By the way, the framework was put together initially by an economist from the University of Chicago, Arnold Harberger. It's a well-known economist, and sort of operationalized by his student, formerly with Harvard University, Glenn Jennings. So this is a framework that has been on and off in Cambridge for some time now. Yes?
Who is the client? Is it the end user or the investor?
In this case, well, we've made the assumption that it's the end user. It's a simplified example, yes.
So population?
Yes, yeah, you can say so. We made this simplification, yes. So, so again, this is sort of these are the numbers of with a set of assumptions, of course. And note that not only in order to get the distributive analysis, note that not only you need to use, for example, in this case, local currency, real terms, but also we have assumed that we're using the same discount rate. So sometimes the numbers do not match because you have different discount rates by stakeholder. So the project has a different stakeholder from, the Ministry of Finance uses a different, discount rate here, and of course, the government often uses sort of the cost of borrowing as a discount rate. So different discount rates. In this case, we have used one discount rate, so that's why they match. Okay? In practice, there are many discount rates. Okay? There's some work on this by Deborah Lucas at MIT Sloan, who argues basically that the discount rate that we should use is the project discount rate for all points of view, because that incorporates not the cost of the funds, but the risk. So, very well. So, so you have the first page. This is sort of the second page. This is sort of private sector provision. In private sector provision, what we have is it's the same template when it comes to society's point of view. Same one, we will see. The only variable that we have changed here is basically the money collected by, in this case, by the sponsor that increases. Now it's 200. 200 makes the project a profit. And now we're in a way in a different world. We have this operation commercially viable. So again, 200 cash inflows, 130 cash outflows, 70 net present value. This point of view has remained the same. And what you have again is the differences here. So in the other case, remember the consumers as a group were appropriating 270. Now they're appropriating only 100, which is a difference between 300 and 200. So now they capture less of the difference. They still make, they still have a gain, but they capture less. In terms of the government position, it's unchanged. So basically, what we see here, this is sort of key difference between these two examples are is in a way this distribution of what is the percentage that is captured by the private sector sponsor and the consumer, as opposed to the previous situation where you have a public sector provision and the consumer. So but this has remained constant. We have assumed this constant. From a ministry point of view, Ministry of Finance point of view, I guess, if we're taking society's point of view, assuming these numbers, we're mostly concerned on this. I'm mostly concerned on implementation. What are our sort of options? Basically, the options deal with making sure we address access, so that in a way that the project is implemented, but whether we do it ourselves as a government or we involve basically a private sector company, deals with sort of our budget position and of course other considerations that we're not including here, dealing with the less technical, right? So there's sort of perhaps the politics of how we structure budgets. Are there any questions?
If we are talking
Yes.
about a project, let's say, of rural electrification, so that people go from not having electricity to having electricity,
Yeah.
the benefit resources saved for clients, what does it mean?
Yes, so indeed, so basically, yes, so in this case we assume that consumers were paying something and now they're paying a lower price. We would need, in the case of rural electrification, we would need to see, for
Yeah, they are
example,
using kerosene or candles or something to have electricity, light.
Exactly, so we will need to see what they're using, if anything. If they're using anything, we'll try to quantify what would be the cost to have some sort of reference of let's say, the before project price. But perhaps, we don't have anything there. So that would even capture more of
Yeah, but maybe in that case you have to include the difference in the utility function for the consumers, right? So the consumers before that had a very low utility function. So they from candles and kerosene, they were getting very low utility value. And then if you have the electricity, you can study at night, the light is better, so your standard of living has increased. So probably it's the difference in the utility for the consumer, what is the resources saved for clients in this case, right?
Right.
The improvement in utility.
We would that be a measure of consumer surplus?
Right.
Okay, yes. So what we're trying to measure here, of course, in this case would be sort of a measure of consumer surplus, and yes, hopefully we will be able to capture that, yes. Yes.
But along this point, at some point are things not financially quantifiable that are benefits to society? So are there other frameworks that have the benefit to society be non-financial that you guys work with, or is this only a financial framework?
Well, this is a starting point, of course. This is a part of this is a starting point for the discussion. Not all decisions at the Ministry of Finance level or at public sector level are, of course, technical. We know that. There's politics involved. There are a number of factors. If we're trying to keep this sort of on a technical discussion, there are also qualitative factors that we would like to address. Especially if, let's say, there's a region that we're trying to support for, because it has been left out historically, for example, and we're trying to compensate in a way. But there are those factors as well, indeed. Yes. Yes.
So there are also different methodologies to value externalities, right? So for example, in the case of pollution, when you try to switch to different technologies that are less against the environment, you are able to quantify it, so you try to put a dollar value
Yes.
on the benefits so that you can actually use them in the economic valuation.
Indeed. So that has been left out of this analysis, but if we were to include, let's say, the economic cost of the project due to, let's say, pollution, we will include it as part of the cost here. So the economic cost in society's point of view. So let's say we can add a negative, so we'll have a value here. So it will decrease, let's say, the net present value from society's point of view. Sometimes we have something, a stable number, sometimes we don't, but we should, if we go through that exercise, we should be able to include it here, yes. We have not included it here. and therefore there will be an impact here on the distribution. That, there will be a stakeholder saying, not sure, perhaps we can say, could be society, or could be, I don't know, my sense is that it's an asset that we're basically not taking care of. Yes, it's an asset within our country that we're not taking care of. Yes. Yes.
I know this is a hypothetical model, but
Mhm.
it seems to me from the government case to the P3 case,
Yes.
the project cost has changed.
Okay.
And also the clients decreased in the P3. I mean, any reason for changing those? Because in the first case with the government, it looked like the project cost was 160. And the project cost almost doubled in the P3 case.
Very well. So we're looking at the
It's
cash flow.
hypothetical.
We're looking at the cash flow.
I'm assuming that's a project cost, right? That cash flow is fine, but if you look at the first one, you had
Right.
130, 30 from the government, 30, 130, that is 160.
No, this is cash inflow,
Yeah,
and below is cash outflow.
okay, so project cost 130.
So the total project cost, yes, the cash outflow
Yeah,
will be
130.
130.
But in the next one, oh, it is still 130. Okay, you're just putting in more private money in.
Exactly. So we're buying this part of the cash, let's say the cash flow statement.
Fine, but then the clients have gone from 270 to 100.
270. Let's see. So from yes, 270 on the net. So they're still gaining, but they're gaining less. They're gaining less because they're making, they have to pay more for their service. They have to pay something closer to their willingness to pay, because it's basically a private sector company that is providing the service, not the government.
So you're able to cover, access is reduced.
Yes, so basically clients still benefit. They benefit in a lower amount, but they still benefit, at least in this exercise.
It's not the number of clients, it's the money.
It's a total amount.
Oh.
It's a total amount. So this, let's say this is in US $1 million in net present values. So
Right.
these are just amounts. So an amount which is basically price times quantity in each case. Yeah.
But I'm still trying to figure out, when you said clients, you don't mean number of people. You
I
just
mean that yes, a group. What is the net present value of that group? In this case, so this is, let's say, a net present value from the sponsor point of view. This is a net present value from society's point of view, and each of these is a net present value from each stakeholder. So this is a net present value here. This is a net present value, let's say, from investment cost. So net present value revenue for the government, investment cost. Net present value government from recurring cost. So, but all these are net present values.
Yeah.
I think, I don't know if it's helpful, but I think what I'm taking away is that the center is basically the project's inflows and outflows, and then the left side and the right side, to either side of the middle column, is basically conserving, right? So it's
Yes.
just, it's more of an accounting issue
Yeah.
of how the project's inflows and outflows are getting divvied up, as opposed to what the project is actually worth to society. And that's always going to end up being 200.
Got it, yeah.
And perhaps another takeaway here is basically that you will be basically talking with different stakeholders. In this case, you're talking. This is a public sector provision. You're talking to, let's say, a ministry of energy, or basically the person or the entity executing that on behalf of the Ministry of Energy. You're talking to people from the Ministry of Finance here, often. Or from, let's say, people that perhaps Prime Minister's office, executive power, that is implementing, let's say, a national development strategy, which has this component. And then you're talking to other groups, basically this group of consumers or clients, we have defined them. And, implicitly, you're also talking to the revenue authority here. In the next scenario, you are talking to an investor. You're talking again to the Ministry of Finance, or you're talking to the Prime Minister's office. If they take the point of view of society, and then you're talking again to sort of the consumers in this case, and to the Revenue Authority. So basically, the framework in a way allows you, of course we can expand this, but allows you to talk to different groups, to be able to identify sort of different positions based on reconciling. Because this is in a way information that can come out of a basic exercise, but often is disjointed. So the idea here is to try to integrate, in a basic exercise, in a simple exercise, to be able to incorporate these different points of view. Yes?
Do you have any examples of where the middle column, the net benefits, are less than zero? Because I think that's really in
negative, you
energy
mean?
projects. Yep,
You mean guess value negative?
right.
Yeah, absolutely.
Rationale. Bridge in Alaska, a lot of people use called $500 million.
Yeah, sure. The question is that depending on whose point of view you take, the project could either look really good
Yeah?
or really bad, even though the value of the project is less than zero, right?
Yeah, I mean, so you can have a project, let's say, that makes sense from the point of view of let's say, the private sector, or from the point of view of the public sector for some reason, but from the point of view of society, it does not make sense. And this is typical. Let's assume here that the cost of the externalities, pollution generated, is 300. So this brings all this value to a negative value. Okay, so because let's say we're using technology that pollutes a lot, that generates a lot of negative externalities, therefore, and because the price system is not able to capture, and we don't have compensating measures, for example, like taxation on those, let's say, polluting technologies, therefore, yes, we can have, a case where this is negative, so society is losing as a whole, but, it still, whether this is public sector or private sector, sponsor, they continue, and, it makes sense for them, because they're not paying for the externality. So let's say there's no taxation scheme that tries to compensate for that externality. But yes, that can happen too. So we have a number of games being played here. We have these two can be positive, but in this case we're making them positive. In the previous slide, we have said that. This is negative and this is positive, we're still, but again, if we go back here, this could be also negative and positive. So this is a place where we don't want to be. We don't want to be really in any place where this is negative from the point of view of society. We also can have a point of view where, let's say a scenario where this is negative and this is negative. So there's no incentive. So ideally, if this project generates a lot of negative externalities, and we're able to tax them, then it doesn't make sense for them to carry on with this project. So that will be fine. The only problem is that, where we have an untaxed huge negative externality that, still does not affect the incentives of the private sector, whether it's public or private. Or I'm sorry, from the sponsor, whether it's private or public. So that's, there are a number of initiatives, ongoing initiatives, I think, right now in Washington in trying to sort of tax externalities related to coal, related to natural gas. We will see how far that goes, related to, the third one is petroleum products, perhaps. So fossil fuels are sort of in the, as part of the discussion now of ministries of finance as part of an energy policy, a broad energy policy. But that can happen, yes, absolutely. And I'm sure it has happened in some of our countries, and it happens in, sometimes even for interest group politics. Yeah. Yes?
Given the timeline of those projects, which is basically maybe 5, 10, 15, 20 years,
Yes.
How do you measure the gross benefit, which is, I mean, compared to the cash flow is tangible, you know
Yeah.
how we can track it.
Yeah.
But how do you measure the gross benefit over such long period of time, given that some new technologies can come up in the equation and
Mhm.
change over time the expected benefit?
Well, so just as a cash flow, you can have, let's say, an investment period of, let's say, 3 years, and then recurring costs, and then you have cash inflows, right? So for this statement, benefit cost, basically you will have the equivalent. So it's in a way a mirror, but just trying to capture the benefits. Let's say the consumer, in this case, would be sort of what people are willing to pay, throughout the life of the project. But that will make an assumption of whether new technologies or all technologies, new technologies enter, or all technologies stay, let's say, or existing technologies stay. So that could impact, yes. It could have an impact on, because we're right now in period 0, we're projecting 15 years in advance. Things will change, of course. And something that we have not say here, basically, this is a deterministic analysis. So this is not a probabilistic analysis, so we need to think of this in terms of also probabilities. This is something that we have sort of we just mentioned for now, but we can sort of make more realistic the exercise if we make it probabilistic. In terms of some of the, let's say, the takeaways, how do we ensure innovation and basic infrastructure projects make a positive contribution to society? Assuming a level of energy demand, the project can make a positive contribution to society if inputs are not subsidized. What we discussed, negative externalities where private prices are below social ones, and it's independent of if it's financing. Basically, we have said that the project can go on because it provides an economic benefit for society. In terms of how we may be able to benefit the less well-off, by providing access to energy at a lower cost than before the project, and in some cases by providing employment. Really depends what the project demands. Sometimes sometimes the project demands different levels of labor. Sometimes it can have an impact, sometimes it doesn't. Sometimes the project brings people from outside because they qualify, have a specific skill that is required from the project and may not be available in, let's say, the community nearby. So again, this issue of we're able to do this sort of integrated analysis because we're using the same unit of analysis, the same, it's called numeraire, what they use in the economic literature, same unit of analysis, in this case local prices, real terms. Very well. Any more questions? I mean, my sense is that we're talking about energy now, but for those of you that are interested in other sort of sectors, the Ministry of Finance, we use the same methodology for looking at, let's say, water. So it's electricity, water, transportation. So these tend to be key sectors in investment portfolio and will remain in the near future at least. So we use the same methodology for these additional investments.
What about health?
Health, we can use some of the tools. My guess is that we can, but I'm less of an expert in that area. Ideally, we should be able, however, to, whether it's public or private provision, let's assume it's public only, we should be able to have some sort of sense of how the program is set up in terms of inflows and outflows. We should have this information for sure. In terms of need to make an estimate of what is the, let's say, the additional benefits, the net benefits that the project will contribute. And of course, we can do that then. But of course, a key part will be here, in measuring what are the gross benefits of the project. So one of the sort of risk variables, if you will, of the project, if you were to sort of look at this, of course, is from the private point of view, is how you make the cash flows stable to be able to service debt, for example. But in this case, we'll be able to make sure that you're not off on your sort of measuring your gross benefits. So that economic price should be very, very sort of a good conservative estimate that allows you enough space to say that this project will make a contribution also.
But I understand the benefit of trying to keep all the units the same.
Mm-hmm.
But in a case like that, it seems to me that this framework would still be appropriate if you put a column in a different type of unit, so you're maybe life years expanded, and then you could look at a trade-off of how many dollars per life years. Like Clinton Health Acquisition has a cost per life saved metric. And I feel like that could drop into this.
Cost effectiveness.
Yeah, cost
Yes.
effectiveness. You
Yeah.
do all your monetary calculations and have a societal
Mhm.
output that may not be that monetary qualified.
Yes, that will be a complementary tool, and that is often used. Yes.
Okay.
Well, please join me in thanking Carlos.
Thank you.